Overnight, China announced $1.4 trillion in stimulus over 5 years. Eunice Yoon.
And China has unveiled sweeping measures to help resolve a ballooning debt burden held by local governments.
This, of course, ahead of earnings season in China.
China's hidden debt problem has been a significant concern for policymakers and international observers. This issue primarily involves off-balance sheet borrowing by local governments and state-owned enterprises, SOEs, which has led to considerable financial risks. In this video, we'll explore the scale of China's hidden debt, the government's initiatives to address it, and the potential global impact. China's hidden debt mainly stems from local government financing vehicles, LGFVs. These entities were created to bypass restrictions on local government borrowing, enabling them to raise funds for infrastructure projects and other expenditures that do not immediately generate returns. This debt is often not reflected in official balance sheets, making it challenging to gauge the true extent of the problem. As of late 2023, the estimated hidden debt in China was approximately 14.3 trillion yuan, $2 trillion. This substantial amount of debt poses significant risks to China's financial stability. The sheer size of this hidden debt underscores the urgency of addressing the issue, as unchecked debt accumulation could lead to severe economic consequences. To mitigate the risks associated with hidden debt, the Chinese government has introduced several measures. One of the key strategies is tightening bond issuance criteria for LGFVs. The government aims to increase transparency and ensure that local governments adhere to more stringent borrowing practices. In November 2024, the Chinese government announced a comprehensive 10 trillion yuan, $1.4 trillion stimulus package designed to tackle hidden debt over 5 years. This package includes 6 trillion yuan allocated to increase local government debt limits and 4 trillion yuan in special bonds. The primary goal of this program is to reduce hidden local government debt from 14.3 trillion yuan to 2.3 trillion yuan by 2028. Another critical initiative is the recapitalization of state banks. The government has launched a parallel trillion yuan program to recapitalize state banks, which involves both alleviating local government debt and freeing up bank capital for additional funding and stimulus. This move aims to address systemic risks posed by hidden bad loans, which often distort credit allocation and financial stability. China is also leveraging technology to enhance transparency and manage hidden debt more effectively. The implementation of blockchain technology and big data analytics helps track borrowing activities and ensure compliance with regulations. These technological tools provide real-time monitoring and reporting, reducing the chances of hidden debt accumulation. Despite these efforts, China's approach to tackling hidden debt faces several challenges and criticisms. One major concern is that shifting debt from LGFVs to the central government or state banks does not address the root causes of the problem. Critics argue that without fundamental reforms in local government financing, hidden debt could continue to accumulate. The market's reaction to the stimulus package has also been mixed. While the initiatives demonstrate the government's commitment to addressing hidden debt, some investors remain skeptical about the long-term effectiveness of these measures. The hidden nature of much of this debt adds to the complexity of managing and mitigating associated risks. China's hidden debt problem has significant implications for the global economy. If not managed properly, it could trigger financial instability that reverberates through global markets. The International Monetary Fund, IMF, estimates that hidden debt could reach 66 trillion yuan, $9.3 trillion, by the end of 2024. Such a scenario could disrupt global trade, investment, and economic stability, particularly in countries heavily invested in China's economy. Additionally, the interconnectedness of global financial systems means that a financial crisis in China could have far-reaching consequences. Investors and policymakers worldwide are closely monitoring China's efforts to manage hidden debt, as the outcomes will likely influence global economic trends. In conclusion, China's hidden debt problem is a complex and pressing issue that requires comprehensive and sustained efforts to address. The government's initiatives, including tightening bond issuance criteria, implementing a substantial stimulus package, and leveraging technology, are critical steps in the right direction. However, challenges and criticisms remain, highlighting the need for continued vigilance and effective policy measures. As China navigates these challenges, the global community will be watching closely. The success or failure of these initiatives will have significant implications not only for China's economic stability, but also for the broader global economy.